Hello and welcome to the third episode of Eagle Investors Market Recap. My name is VISHU NAMBURI and I'm the Chief Investment Officer here at Eagle Investors. Today is Sunday, April 5th, and in today's episode, I'm joined by both Oliver Rios and Meredith as well. They're moderators here at Eagle Investors, and they'll help with our discussion as well. So for today's episode, we wanted to focus on the current oil outlook, have a discussion on where we see gold going from here, talk about treasuries, government infrastructure bill, a current Fed policy, the coronavirus update, going into key economic data from here, looking into company balance sheets, and talking about the confusion on stimulus and how it can impact regional banks specifically from here. Just a couple market updates. The S&P 500 is down 23.6% year to date and down 2.9% for the week. And specifically for coronavirus cases have crossed 1.2 million, and the death toll is close to reaching 70,000 from here. So just to start off with going into the current oil outlook, I would like to hear Oliver's opinion on where you see oil going from here.
Okay, so my prediction of oil is kind of bleak, to put it at best. I'd say probably about 15 to 12 a barrel, mainly because of the state of the futures market. The shape of the curve is in a state called contango. And by that, I mean price action in the futures curve is actually sloping downward in the front month. And in the back month, it's higher. Typically, what that means is that it makes more sense to either leave it in ground or leave it in storage. Based on what we saw in Cushing inventories this past week, we're already seeing that the expectation for inventories to grow is going to continue. Prior to COVID-19, we actually did see a build in inventories, both in oil and in gasoline inventories. And we also did see a drop in refinery numbers that a lot of analysts have been watching. So this is a demand shock. Oil cuts will not fix this problem. It's more of a issue between supply and demand, which will be figured out post this COVID-19 time period. The other concerning part for many oil producers will be combating the psychology of post this period. A lot of people will not want to get on planes or travel in general, which can be very concerning. Oil is considered the lifeblood of the global economy. So going forth, it will be very important for things to get back on track. My expectations with oil, as in comparison to other commodities, it's telling me that we're about to enter a situation of stagflation post this period. That being said, I expect numerous types of stimulus activities coming out from central bank. I'm expecting more measures, both in a monetary sense and in a fiscal sense, due to the reaction to COVID-19 and just maintaining that, getting grasp back to normal in psychology.
Okay, so those were some great points. And then so another thing I wanted to hear on was your opinion on Russia and Saudi Arabia from here, and the OPEC meeting that was supposed to happen on Monday getting pushed back. Do you think that the chances of the OPEC countries cutting production from here are high, or do you think that we won't see an oil production cut from here?
Okay. So my expectations on OPEC as going forth, I mentioned that this is a demand shock, so supply cuts won't fix the problem. my expectations are that it's going to take time for them to actually come to an agreement on things, because Russia's main thing is that they want to maintain production. Rosneft has been asking their government for a long time to pump more. So there's actually an incentive for Russia to keep going, both in the sense that they can, and it serves more than one purpose. In the current situation that we're seeing geopolitically, this is very similar to other tactics that Russia has used in the past, uh, which is not necessarily a bad thing. It's just more of people don't understand what's going on behind the scenes. Um, the implications of using tariffs would actually be a negative factor. It would do the opposite of what people would think it would do, as in raise prices. We saw that in other commodity markets where tariffs were involved, for instance, steel and aluminum. But it's more along the lines of some supply and demand disruption.
Yep, I have to agree there. And before the call, I was actually sent two graphs over. So I have the current futures graph up, and then here's crude oil, or gold price to crude oil price chart as well. Is there anything you wanted to talk about these two graphs in specific?
Okay, so typically gold to oil stays in a range between $10 and $30. By that I mean, for every 10 barrels, it would cost to buy 1 ounce of gold. So typically it stays between 10 to 30, but right now we are actually at historic levels, which we have not seen in a very long time. What that comes back to, from the point of a miner, is the marginal cost at which you can go and mine gold, because mining gold is very energy intensive. What we're seeing here is that short squeeze inside of oil on the very right hand side, actually pulling down the price of gold to oil, which is good. So what we should likely see this coming week is a bounce back to the top, possibly a break. The main reason that this is going on is the last OPEC meeting, why it fell apart, was both Saudi Arabia and Russia were disputing how they could figure out how to fix this issue. Initially, Saudi Arabia came out and they asked Russia, hey, can you help us cut 1 million barrels? Russia said no prior to the OPEC meeting. And then when it came to the OPEC meeting, which the price action during that time was really fun. When it came to the OPEC meeting, Saudi Arabia came out and said that they were doing 1 million barrel cut. And then Russia said no. And then immediately price fell like a rock. Yep. So the main question is this a terrible April Fool's joke? By that, I'm saying if Russia and Saudi Arabia and the rest of OPEC can't agree on 1 million barrels per day cut, why would they agree on 10 million barrels per day?
Yeah, I think that's a great point. So looking into just the past week, we saw a lot of optimism of a barrel cut, but now it's looking like the chances of a cut are becoming lower and lower, and people are very skeptical of whether we'll see a cut or not. So potentially we could see this reflected in the oil price coming in this week as well. So that's something that we're making sure we're keeping our eyes on as traders as well.
Right. And what will result of this will be a spike in both realized volatility and implied volatility, meaning prices they're going to do some some magic.
Yep, it's gonna be this week's gonna be very interesting for oil. And then I pulled up the futures chart as well. Is there anything you wanted to mention about this as well?
Okay, so this chart is a chart of the Chinese currency compared to the US dollar. This is the CNH versus USD. Usually I use this as a barometer. Like for instance, during like the trade war, I would use this, copper, hogs, cotton. But what I feel it's likely to be is trade tensions, tensions within the South Sea, um, or a possible second wave of COVID-19 inside of Asia
That's a
based on price action. So,
Yep, that's a great point. I know China is trying to get back to normal currently, and I know you can find data such as going on like TomTom, looking into like Beijing traffic rates, and they're saying that there's still progress for China to come back to the 100% full force like it was before. And there were also reports coming out saying that there were millions of telephone contracts that were canceled as well. So that shows that the numbers might be off for the coronavirus cases and the coronavirus death rates as well. And also shows that there might be more businesses that are impacted in China than we thought as well.
right. A lot of people compare this to 2016, but the difference between now and 2016 is the level of leverage within China, both in the sense of real estate and the fact that they're kind of at the brim of what can be done both fiscally and monetarily. By that, this chart, what it's showing is extreme inflation.
Yep.
So typically what happens when you have extreme inflation but lack of growth, that's when the pitchforks and torches come out. So that's another X factor that could be getting ready to happen, is more civil unrest.
That's an interesting point as well. So something to definitely keep an eye on. Another thing that we wanted to go over in this podcast is going over the coronavirus update. So currently, what I'm focusing on is a number of cases within Europe and the United States. I think this is a potential indicator of a bottom in the market if once we reach a peak in the number of cases within the U.S. and Europe. So within Europe, the specific countries that I'm looking into include looking into Italy, Germany, the UK, and then within the United States, some cities that I'm focusing on include New York City, and then looking into numbers from California and Washington as well, as they were the first regions to get hit. Specifically with New York City, we're still yet to see a peak in the number of cases, and there are reports coming out of Italy, Germany, that numbers are still becoming worse, but there's a chance that we could see a corona peak within the next couple of weeks. So within the US as well, we have to see what kind of action we're seeing in the hotspots specifically, and seeing if the fatality numbers are going to rise further as well. Another thing to look into for coronavirus is looking into successes for drug treatments as well. Something that investors are looking into specifically are Gilead Sciences, and looking into Regeneron drugs as well. Potentially this could boost sentiment as well and lift the markets further if the drug trial data that's expected to come out around the end of April does well, then we could see a potential catalyst for the market as well. And then another thing I wanted to go over was Fed policy. Is there anything that Oliver or Meredith wanted to talk about here?
And I personally feel that the Fed is stuck in a trap. By that, let me actually give me a second. This is like an edit thing. I have like a
Good.
whole little explanation spiel I posted a little while ago. Kind of just emphasizing why I buy gold. All right. So, main reason I feel the Fed is stuck in a trap is because the government is currently on life support. Some of the new programs that they have, it offers an incentive to global people rather to sell treasuries to raise dollars, that they should just swap them with the Fed, and the Fed will absorb it on their balance sheet. It's a very concerning situation because longer term, what that will mean is just in general more inflation, which is definitely one of the goals that the Fed wants, because this type of shock, inflation will actually work in their benefit because they can use those different treasuries to manage the yield curve and incentivize lending again. Because the main thing here is the psychology going forth. That's the X factor that our tools cannot handle. Inflation is worse than deflation. I'll just say that.
So something that's interesting is looking into inflation expectations from here. I think that with the rate that the Fed is putting money into the economy, we could see inflation expectations rise significantly from here. So as a result of that inflation, we're seeing in terms of the fundamental views on gold, fundamentally gold is a strong play, but something to look into is if the market does indeed further sell off, we could see institutions get rid of their gold hedges, and as a result, we could see gold prices go further from here. But fundamentally, if inflation continues and we see the Fed continuing to put money into the economy, which we will probably see, then gold is a great play, especially for the long term.
Another X factor that we're not taking, well, I'll do a pause and then I'll jump into it, all right?
Okay.
Another X factor that we're not taking into account for is what interest rates will do globally and that effect on trading psychology of currencies. Fundamentally, gold is a currency. It retains its nominal value, but since currencies globally will be changing in relative value due to the fact that interest rates are likely to go lower, that's going to create a similar situation in oil, kind of like the contango effect, where the cost of carry will actually diminish the value of holding currency over time, meaning that gold is actually going to be a better store of value.
Yep, that's a great point. Now going on from the gold discussion, and something that I wanted to talk about is the upcoming government infrastructure bill, and seeing if we can get an additional $2 trillion put into permanent infrastructure. This is interesting because we saw steel rally as a result of this, the potential of this bill coming through. So something that I was specifically looking into was U.S. Steel. So U.S. Steel did see a rebound. Question is, how much resources of U.S. Steel are we going to see used as a result of this bill? So that's something to look into, and looking into other stimulus plans as well. Something I'm looking into is seeing the bailout need within multiple industries. So looking into entertainment industries, looking into airline industry, hotel industry, looking into casino industry, and there are many more industries that are getting impacted by the virus. And are we going to see the government bail them out, or are we not going to see them bail them out? And we could see large impacts on both sides of the market, depending on what the actions are from here. So that's something we're keeping our eyes on, and we're looking into over leveraged names within these industries and seeing if there are potential short plays.
Yeah. The main thing, as far as this goes to Fed policy, the main thing we got to do here is pay attention. Are these players investment grade? Like is the debt that they're in investment grade, or is it junk? If it's junk, then that's likely not to be saved. But if it's investment grade, then that can be saved. The main thing with that being said is, in order for the junk rated companies to be saved, they would have to revise the Federal Reserve Act. I don't think that would be particularly a wise decision in an election year. That's just my opinion.
Yep. And then there also talks about the Fed potentially buying a specific company stock and also buying ETFs as well. So looking into specific debt ETFs, looking into LQD, for example, and TLT as well.
Right.
Yeah, I think what makes this situation really unique and so hard to predict is, unlike almost any other crisis or situation, there's really no timeline or really a true ability to predict how long this is going to last. We don't know if the warm weather is going to help kill the virus, now that it's officially springtime and summer is around the corner. We don't know if there's going to be a second wave. And I feel that the longer this goes on, the more we're going to see these questions of the battle between public health, essentially, and economic safety. And or economic security. And that kind of debate is going to pop up all over the world. I mean, Italy is a total mess right now, especially with Lombardy being the biggest economic region in the country, with it being the third largest economy on the euro. That was the region that was hit the heaviest by coronavirus initially and completely had to lock down during the end of Fashion Week time for its economy, where a lot of people come in from outside to a traditionally not super touristy district of the country. And so all of this is impacted, and I don't think we've even begun to see the real effects of all of these impacts yet. And I think we're really going to start to see the issue between, it is really important for public safety for us all to be staying at home right now, but the longer we continue to do this, the more it's going to impact the economy. And there's only so much the federal government is able to do and the Federal Reserve is able to do in terms of stimulus plans and bailouts. And so it'll be interested to see if it comes to it, if we have to make the decision of, public safety versus economic health. And I think that, if we see these social distancing orders continue past May into June, I think is when we're going to start to see those questions really become major concerns, and where I would think that, I would seriously be concerned about the economy. Right now, there's concerns, but what goes up must come down. There's natural recessionary periods, and we were at the end of the biggest inflationary period in U.S. economic history. So, of course, that will happen. However, I feel that the longer this goes on, the more likely it is to be a depression and actually have real lasting impacts that could take decades or more to recover from.
So that actually brings a great point as well. So since there's so much uncertainty, we're seeing more volatility in the markets. But this past week, we've seen more consolidation within the markets as well. So actually last week, as you can see from what I'm pulling up right now, this is the Fear Greed Index. So it takes into multiple different indicators to see what the current market fear conditions are. So last week it actually reached the level of 2, and now we're reaching the levels of 21 to 23. The markets are becoming less fearful, and we're not seeing as much volatility right currently, but there could be a potential rush back into volatility if we see more uncertainty of when jobs are going to come back. I know many people are predicting that the peak's going to be in 2 to 3 weeks for the coronavirus cases, but is that really going to be the case? So that's something you have to keep in mind.
Right. That kind of goes hand in hand with kind of like one of the things that I wanted to talk about was just volatility in general. What we've been seeing for the past few weeks has been unprecedented monetary stimulus. Probably the most that we have ever seen in our lifetimes. Well, I mean, both in the sense of people that were trading in 2008 and prior to that, and yeah, it's mind-boggling. We've seen lots of different new alphabet soups come out, which are all geared towards getting the economy back on track. I guess the question that I have for you guys is, when do you put the Band-Aid on the bullet hole? Do you let everything drain out, or do you try and put it on and stop the bleeding immediately?
Yep, that's a great point. So, like we saw with the Fed, immediately they tried to come up with specific plans to help the economy. I believe that if we see policies that come out immediately, that's better than letting it be for a couple of weeks and then seeing the results. So it's good to be in front of the problem rather than after the problem comes, trying to fix it.
Right.
Yeah, I absolutely agree with VISHU here, because especially with the uncertainty of the timeline with all of the COVID-19 issues, I think that acting sooner rather than later is absolutely imperative to putting both public health and economic health of your country on the right track. I mean, the countries that reacted the latest, like Italy, we've seen that those are the countries that have taken, some of the biggest economics and public health hits. And I think that that's for a reason. So
now my last question for you guys would be, there's a saying, to every man with a hammer, everything is a nail. So this to me is no different in this situation. Like, we've seen a lot of companies that should not be in existence still stay in existence. So in terms of moral hazard, how would you guys feel the effectiveness of this? Is the risk of moral hazard worth saving?
So that's an interesting point. We've seen companies that are over leveraged beyond their means get hit pretty significantly as a result of this virus. So this is a point where people are or companies themselves are gonna think about prioritizing liquidity and focusing on having a strong balance sheet. From here, in terms of seeing government support, that's something we're gonna have to see. I potentially think that the government can't bail out everyone, so they're going to have to pick and choose. And from there, that raises a lot of questions on why they would choose specific industries as well. So we'll have to see.
Yeah, I mean, I think I think this is very different from 2008. I think from a logistical standpoint, all of the industries that are going to have major effects from this crisis, there's just not going to be the means for the government to be able to bail out all the companies that would theoretically need to be bailed out for the economy to be in the same condition that it was before the crisis, as far as, with the same companies existing for the most part. But I think that it's going to be really interesting to see which companies get chosen and which ones don't. And I think the fact that we're very close to a re-election could factor into which ones get chosen and which ones don't. It looks like crony capitalism in the selection of the companies and the industries that are getting the most stimulus. That could definitely work against the Trump campaign. So it really just depends how much Congress is going to be overseeing it, how much the Trump campaign and the Trump office or Trump administration is going to be involved with the stimulus plan. I think that it probably will make people really upset, and regardless of who they pick, people are going to be really unhappy with the government, which I think will be very interesting for any current officials going into the upcoming election. But I think it'll be something we'll have to see. I think that there is going to be some companies that are going to have to fail, but it will be interesting to see how they end up deciding which ones they're going to let fail and which industries.
Right.
Oh. And then those are some great points, especially putting politics into this. Like, there's going to be a lot of picking and choosing, and with the election season coming up, it's going to be very hard for politicians to agree upon specific companies as well. So just going on to the last topic that we wanted to talk about today is how regional banks are going to be impacted, and we could potentially talk about some trade ideas we made as a result of the potential impact on regional banks as well.
Okay, so that part, I mean, that was more of just like what I'm seeing price action wise in the charts.
Yep.
But yeah, I don't really have a direct thesis as to why things are working the way they are. But the main thing is that price action wise in the small caps have been the ones that have led the market up as far as this bounce. And they're also the ones that are leading it back down with the fall this Friday. And just in general, they're the weakest index out of the group. And if you break down the IWM by holdings ranks, which I often do, regional banks are actually the highest, what's the word I'm looking for? I guess the highest percentage, right?
Yep.
So I don't really have a thesis directly geared towards regional banks. It's more of just like price action.
Okay, and then just building upon that, I think we're going to see solvency needs for companies change. So with so many companies potentially being over leveraged at this point, they're going to have to, like I said before, they're going to have to prioritize cash to pay their bills. And we could see companies default from here or delay on payments. And that's going to have a drastic effect on the economy. And so we're going to have to see if they can pay them back. And within regional banks specifically, if you look at down south, the oil and gas industry is getting hit significantly. So one of the companies that I've been looking into is Prosperity Bank, and they have a lot of their operations down south. So we could potentially see regional players not be able to pay their banks. So we could see impacts on the regional banks there as well.
Right, and I guess just in general for regional banks and banks in general, where interest rates are at, it's going to affect their overall margins as far as operating income.
That's a great point as well. And so when looking at specific banks, it's important to look into their loan beta as well, which measures how impacted they are by interest rate changes. So that's something to look into, and then we could potentially talk about on a future podcast as well. Thank you, Oliver and Meredith, for joining the podcast today.
What's going on here is that price action is consolidating. Price has gone higher, but volume leading it into a broad formation, typically known as a bear flag. So what's likely to happen is that volatility from here is likely to spike up, and price is going to fall. So I guess the measured target is about 210-ish. Is that what it says? I can't see it from here. as far as like the next level of support down. That's the previous low.
Yeah, so it's 218.26.
Right. So typically what we would see price action wise is that gap between that candle and the following green candle will probably get filled. From there, where we go, that's a question mark. But as we've been watching all week long, or I know at least I have, the volatility, or the measurement of buying action on the volatility futures has actually been in a consolidation as well. So I'm suspecting that we're going to see more volatility from here, which makes sense.
Yep, that's a great point. We saw some consolidation here, and from now we can see increased volatility and volatility flood back into the markets. It was great to talk about the market as a whole, hearing your perspectives on on what we're seeing and where we see potential equities and asset classes going from here. Thank you.